Hey, hello investors and future investors. Welcome to the channel. For today's video, I'm going to be doing a live trade. I'm going to give you a step-by-step walkthrough of what I go through before I decide to place any option strategy. I'm going to also show you how to use the market momentum in order for you to make some huge gains. Now, if you're new to options trading or you're trying to use options in order to get some additional income, then you so happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make continuous income. For today's video, I'm going to be trading none other than CRWV, and that ticker is going to be CRWV. Now, I'm going to show you the step-by-step process of what I do in order for me to do a trade. Now, although this is a live trade, this is my trade, not your trade. That being said, always make sure to do your own due diligence before jumping into any options trade. And secondly, always make sure to have an exit strategy. So just in case the trade goes against you, then you know how to get out of the trade. Now, let's go ahead. We're going to go and get down and dirty with options by going down to trade CRWV options down to the bottom. Now, we have our options chain open and our option chain is right here. I'm going to use this information down here in order to make a decision. Now, I'm going to go ahead. I'm going to show you my strike prices. And at the end of the video, I'm going to show you my criteria for choosing those strike prices. So first of all, I'm going to go to sell. I'm going to be going to put. I'm going to be adjusting my strike date. I'll be going with 2 weeks out, and that's going to give me July 25th, which is 11 days to expiration. The reason I'm going to be doing 2 weeks out or just 11 days is that this stock is extremely volatile. So as a seller of options, you want to give the buyer as little time as humanly possible in order for the trade to work against them. Now I have sell, I have put, and I have my 2 weeks expiration date. I'm going to go ahead and select my strike price. The strike price I will be going with is going to be the $120 price right here. Now, that $120 price right here gives me a chance of profit of around 74.81%. Let's just round it up to 75% just to keep the video very simple. So, with my strike price of 120, my chance of profit of 75%, I'm going to go ahead and I'm going to select that one. This is the first leg of a 2-leg option strategy. So now this is a sell put. I'm going to be getting paid. Now let's go ahead and continue to the second leg of this option strategy. And I promise you, it's all going to make sense. Now we're going to go ahead to buy. We're going to go ahead to put. We're going to maintain the exact same 2 weeks expiration date. I'm going to go ahead and select the strike price right below the first strike price I chose, which is going to be 119 right here. Let's go ahead. We're going to select that. Now, this second leg of this option strategy is a buy put. So once you buy in, you have to pay. So this also is known as the put credit spread. The put credit spread is what's known as an income generating option strategy, meaning as soon as you decide to go ahead and do this option strategy, you're gonna get paid. In this instance, the amount you will get paid is going to be a difference between your buy put and your sell put. So pretty much a difference between here and here. So let's go ahead. We're going to hit continue. We're going to hit review order. So once I do this trade right now, I'll be getting 39.92 or $40. That's going to be deposited into my portfolio, and that is mine to keep no matter how this trade go. I did tell you this is going to be a live trade, so I will be executing this trade. Now, before I go ahead and hit the execute button, I want to explain one thing to you guys. In order for you guys to do this option strategy, you are required to leave a collateral. The collateral you're going to need to leave is this. It's going to be based on whatever your spread is. In this case, it's going to be $100. The reason why it's $100 is because my spread is only $1 wide. Let me go ahead and show you. So the difference between your strike prices is what's going to be known as your spread. So the difference between the 120 and the 119 gives you $1, and you multiply the $1 by 100. The reason why you multiply by 100 is because you're dealing with options. So each option contract does contain 100 shares, and that's what gets you your $100 collateral. If you were to go ahead and choose the strike price of 118, then your new spread is going to be a $2 wide spread. Hence, your collateral is going to now increase to $200. All right. So let's go ahead and see what they're saying right now. So what they're saying right now is that the bid-ask spread is way too large, so I need to make an adjustment. Now, you see the Right here, your limit price, your bid and ask is extremely wide. You have 0.1 here and 0.7. This is stereotypical of very volatile stocks. The bid ask is extremely wide. What I'm going to go ahead and do now, I'm going to adjust here and I'm going to choose the exact price what they have. Let's go ahead. I'll show you how to do that. So we're going to go back right here. We're going to hit enter limit price. Now I'm going to put, it shows now, it has changed to 0.5. The price is changing right now because the market is open. That's why I hardly make these videos when the market is open. So what I'm going to do, I'm going to go ahead and put in the first price, which is going to be 0.4. So that's the first initial price that they gave me. Feel free to put in whatever price you want here. This is based on your personal goals or what you want to achieve with your portfolio. Now remember, the higher you put this price, the lower likelihood is going to be for you to get filled. For instance, I have 0.4, and as you can see, it does say to the bottom, it says low likelihood of being filled. So I'm going to go ahead and adjust it. I'm going to put 0.2, and you see it now says a very high likelihood of being filled. Now, with 0.2, that means I'm only going to be receiving $20. I don't want to be receiving $20 because this stock has to be, the risk has to be equal to the reward. So I'm going to go ahead and put back 0.4. Let's go 0.45. I think that's a decent return if it gets filled. Let's go ahead. We're going to hit review order. I'm going to be getting a credit because I'm selling options. And then now I'm going to go ahead and I'm going to execute the trade. Let's go to submit, and hopefully we get filled before this video is done. Now, how do I go ahead and get your strike price? So I'll show you. Let's go ahead now, and we're going to open up a completely different browser. And now what I'm going to do, I'm going to type in CRWV expected move, and you just hit enter. And then more than likely you will see this, but this is a bit confusing, especially if you're new to options. So what I would advise you to do, you're going to go ahead and look for the expected move from barchart.com right here. So let's go ahead. We're going to select that. Now you have to remember your expiration date. So once this finishes loading, we're going to go ahead now. We're going to go down. Let's just get rid of this free advertising right here first in order for us to get a better accurate picture. You guys see how hard these is to make when you're doing it live. So now I'm going to go down and I'm going to show you guys the expected move. So the first category is going to be expiration dates. Now the expiration date I chose was 25th of July right here. If I go all the way down, I'm going to see there's a lower price and there's a higher price. Because I'm selling, I'm going to be going with the lower price because I want to make income and I want to make sure that the trade goes in my favor. Now, as you can see here, what this is actually saying that on the 25th of July, they expect bar chart to be on the lowest around $121.46. Hence, I went ahead and chose my first strike price even a bit lower because I'm pretty conservative. Feel free to do what works for you and your portfolio. Now, this is the basis I chose in order for me to get that particular strike price. If you guys want me to show you an option strategy that's going to show you how to use the upper strike price, just let me know in the comments below. Just put upper strike price and I'll go ahead and make that video for you. So let me go ahead and see if that thing got filled. Let's go back to Robinhood. If it hasn't gotten filled, I'm going to go ahead and just let you guys know and just make a secondary video just to follow up with this one. So expiration date is July 5th. Now, before I end this video, I want to bring something very important to your attention. With option spreads, it's highly advisable that you close the trade before expiration date. Now, I always mention, always have an exit strategy. My exit strategy is going to be to close this thing way before July 25th, and I'm going to be closing it whenever my chance of profit hits a 50% mark or higher. Once that happens, I'm going to go ahead and close this. I'm going to lock in my investment gains, and Bob's your uncle. Now, for those of you guys that made it to the end of the video, you guys are the real investors and future investors. If you guys haven't already, go ahead and like the video. Subscribe to the channel. Make sure to share this video with someone you know that can help from its content. I do put out these free content out here in order for us to help a lot of people get income from trading options. So until the next video, keep pushing your investments.